Hi, good evening all. I'm Ridil Mishra from the corporate communication team, and on behalf of CareEdge, I welcome you to our today's discussion on cement, straddling between demand, growth, and cost. We sincerely appreciate your time in joining us for this webinar. We would like to welcome our esteemed guest speakers for today. We have with us Mr. Arvind Pathak, Managing Director and CEO, Birla Corporation Ltd. Mr. Dharmender Tuteja, CFO, Dalmia Bharat Limited, Dalmia Cement Bharat Limited, Mr. Jigar Shah, CFO, Wonder Cement Limited, and Mr. Anil Sharma, CFO, HeidelbergCement India Ltd. The session will be moderated by Mr. Sachin Gupta, Chief Rating Officer at CareEdge. We will commence the session with a presentation by Ravleen Sethi, who is the Associate Director at CareEdge. This will be followed by a panel discussion. After that, a Q&A session with the audience at the end of the discussion. In case of any queries, you are please requested to key in your panel. Now, may I invite Ravleen to make a presentation, please.
Thank you, Mradul. Good afternoon, everyone. Cement industry has gained scale driven strongly by the housing and the infrastructure sectors. And with the demand and foresight and also the zeal to capture the higher market share, players have announced capacity expansions. What has been hurting the industry, however, is the inflationary pressures from cost side with limited ability of the players so far to be able to pass these in the form of rise in cement prices. As the sector enters the stronger half of the year, we at CareEdge thought this will be an opportune time to give our view on the sector and understand from the experts on how the industry is expected to navigate through this maze of growth and cost inflation. CareEdge rates 21 companies across large, mid, and small size players, with significant 43% of the rated portfolio in the AA and above categories. To set the context for the flow of the presentation, the key messages are that we expect cement demand to witness 8 to 9% growth in FY23 and to grow thereafter by 7 to 8% over next 2 years. Most planned capacities are by the large players, and the utilization levels are expected to be in the range of 66 to 68% over next 3 years, given the upcoming capacities. We will then talk about the prolonged cost battle that the sector has been battling with. Players will witness the moderation in the operating margins. But despite the moderation in the profitability, the credit profile of the players remains largely stable, owing to stronger balance sheets and deleveraging that happened in the last 2 years. Let us now have a closer look at each of these key messages. Here we are talking about the demand trend. In Exhibit 1, the blue bars are the total cement demand. The blue line is the year-on-year growth in the demand, and the green line is the GDP growth rate. We have tried to segregate this period into different phases since FY15. As we can see that in the period from FY15 to FY17, it was a period marked by factors like slowdown in the real estate sector, the stuck infra projects, demon, and implementation of RERA. In this period, cement demand grew by 4 to 5% year-on-year, though a degrowth was registered in FY17. Post this, period FY18 to 19 saw a substantial pickup in the government infra spend and affordable housing segments as well, and the cement demand peaked in FY19 to 331 million tons. Thereafter, the momentum was broken post the credit crisis in 2019 and with the onset of the pandemic in March 2020. This led to flat demand in FY20 and the volume degrowth in FY21. In FY22, cement demand witnessed a healthy growth backed by increase in housing construction and the infrastructure construction, which led to a V-shaped recovery. With this, the interesting fact is that the cement demand stood at 350 million tons in FY22, surpassing the pre-COVID levels in FY19 of 331 million tons, which is a 5.5% growth. In the current year as well, in the first half, the overall cement demand has registered 10% growth approximately over last year. And on full year basis, our expectation is that demand should register a 8 to 9% growth in FY23. Post that also, the demand momentum will be accelerated by higher government infra spend owing to general elections in May 2024. There is a positive correlation between the GDP growth rate and cement demand growth. In FY23, CareEdge estimates the GDP growth rate to be 6.5 to 7%, and accordingly, we are expecting the cement demand to GDP multiplier to be restored back to 1.1x. Moving on, let us see the end user segment-wise cement consumption. In general, the end user sector mix is in the cement industry comprises of the housing, including the low-cost housing, which is 66 to 67% of the demand, infrastructure being the 22 to 24%, and industrial being 10 to 11%. Though housing will remain the key volume contributor, the bedrock as we call to cement demand on the back of the housing for all and pickup in real estate, it is clearly expected that the share of infrastructure would expand in the medium term. The laying down of the national infrastructure pipeline in September 2019 and a step up in the same with the total outlay now being at 142 lakh crores is a clear indicator that infra shall lead from the front. Also, 70% of the projected infrastructure investment under the NIP comes from the four infra sectors, which are roads, energy, sanitation, and railways. So for infra, we are expecting the share to go up to 26% from the current levels. Coming to industrial and commercial segments, the production-linked incentive schemes worth 2.4 lakh crores in the next 5 years and the corporate capex pickup are the key drivers in this segment. The industrial capex is though yet to come at its full pace by corporates, but shall support the overall demand volume over the medium term. Moving forward on the demand drivers, we'll briefly talk on housing and infra side. So under the housing programs of government, namely Pradhan Mantri Awas Yojana, Grameen and Urban, we expect the programs to maintain the momentum. As we can see in the Exhibit 2 and 3 on the left-hand side, the total targeted houses under both urban and Grameen are 39 million houses, approximately, of which close to 25.7 million are completed as of October 2022. This number is up from 21 million houses which were completed in November of 2021. So in the urban Yojana, South, West and Central regions will derive the demand as it is visible from the graphs, while in the Grameen Yojana, there is a higher percentage of pending projects in the East and Central regions and likely higher demand in those regions. The real estate sector is also witnessing a demand revival. While it seemed that the sector would take longer to recover from COVID, but contrary to the expectations, the sector witnessed green shoots much quickly. The improved in sales traction is such that sales and launches in H1 of 2022 have climbed to an all-time high since H1 of 2015. We have shown this in Exhibit 4, which is the graph to the extreme right below. While the demand is likely to be impacted to a certain extent by further increase in the home loan interest rates, but the same being still below the pre-pandemic levels, it is likely to maintain affordability levels for the end users, leading to the real estate demand and in turn support the cement demand. Moving to the infra side, infrastructure pushed by the government in the Union Budget of 2021 revived the demand for cement in FY22. During the year, the country witnessed projects worth 2.9 trillion completed under the NIP. And even in 2023 budget estimates, 7.5 lakh crores was allocated to the key infra sectors, which is almost 35% higher than the last year, wherein it stood at 5.5 lakh crores. For the government has already spent around 40% of the projected outlay in H1 of the current fiscal. A step up is required in H2 to achieve the overall target. We have listed briefly on the budget and completion of the work under few cement-intensive sectors here, like the dedicated freight corridor is set for completion by June 2023. The current project progress is about 85%. With respect to the urban infra through Amrut and 100 smart city schemes, the enhanced budget allocation there as well will contribute to the overall cement demand. Noteworthy here is that 21 out of the 100 cities where projects are under development are in the eastern region. Coming to the metro works. In metros, civil work constitute close to 40 to 50%. And in Exhibit 5, which is at the top right, we have shown region-wise approved, under construction, and upcoming routes to understand which region may see higher demand from this segment. Further, the government's focus on roads and highways is also increasing, and it has been evident from the fast-track approvals and completion of the projects, and also the higher budgetary allocations. A well and a timely progression of these infra projects would offer a direct or an indirect demand opportunity for the industry, and this shall bolster the cement volumes in the next 3 years. As the sector is having regional flavors, we have here summarized the region-wise and end-user-wise demand drivers. The dark green circle represents the high demand, light green being moderate, and orange being low. East would see the high growth backed by higher government spend on infrastructure, affordable housing, and pickup in construction. And the overall cement demand will be driven by all regions, but particularly East, Central, and North are likely to witness higher levels of growth, which shall also aid in higher utilization levels in these regions. Let us now have a look at the supply dynamics of the industry. With volume growth in foresight, the large and the mid-sized cement players are planning expansions. Here in Exhibit 7, we can see that industry is likely to witness around 110 million ton capacity between FY22 to FY25, which is next 3 years. Just for emphasis as well, in the last 6-year period from FY17 to FY22, the industry witnessed a similar capacity expansion. However, we expect the demand to back up this upcoming capacity. Therefore, we are not expecting any decline in the utilization levels. Our expectation is that the capacity utilization levels will be at 67 to 68% over the next 2 to 3 years. The pace of the expansion and the demand matching up to it will be a key monitorable though, that shall determine any intermittent demand-supply imbalances. This is the pan-India utilization. And now we are moving to the regional utilization levels. The regional impact of the pandemic-led lockdown had resulted in dwindling utilization rates across different regions in FY21. And as the demand rebounded, the utilization across regions increased on enhanced base of the capacity in FY22. Let us look at the North and the Central regions first. The North and the Central region witnessed subdued capacity utilization in FY21 due to production shutdowns in Q1, demand declining, and massive reverse migration of labours as well. However, a sharp recovery in the operating rates, as expected, was witnessed in these regions. Coming to South, it continues to witness lowest capacity utilization as the wide gap between the capacity and the production has led to poor utilization levels over the years. Also, the pandemic severity in the region dragged the utilization levels to the lows of 45% in FY21. In FY22, the demand rebounded and the capacity utilization was restored to earlier levels. And so far in H1 of FY23, demand in the southern region has been a dampener in some pockets due to excessive rains. Eastern region has the highest capex plans, which may weigh down the utilization levels in the near term from its pre-pandemic levels. 31% of the planned capacity is upcoming in the East region. Hence, operating rates would remain range-bound at 63 to 66% levels in FY23, with surge in capacity additions and also some inbounds from the southern region. The expectation of the higher demand due to the various announced projects has led to the expansion plan in this region, but any variation in these demand drivers can lead to a situation of capacity glut similar to what was witnessed in the south. Coming to the West region was the region with the maximum impact of the pandemic during the initial period of the outbreak. It was the hardest hit with stringent lockdown conditions. The capacity utilizations in the West consequently declined from 70% to 60%. However, in FY22, the region witnessed increased utilization levels as production augmented, led by the infra and pickup in real estate. The new entrants adding capacities in this region and the inbounds from the south and north would limit the utilization levels in FY23 to around 68%, and these are below the pre-pandemic levels of 70%. West is the region where we expect that demand would grow at a lower rate compared to other regions, and hence it will see least expansion from the players as well. Moving on, let's see region-wise capacities and share by the players. In the Exhibit 8, we have given the capacity breakdown by regions in FY21, FY22, and also shown the breakdown of the industry capacity post-augmentation in FY25. We can see that the share of Eastern region would increase from 23% in FY22 to 24% in FY25. North will also see a bit of jump if all these capacities as planned come up in the given time frame. Further, in Exhibit 9, it can be seen that the industry is fairly consolidated in nature. The top 4 players, which is top 5 companies put together, hold 47% of the capacity share, and the top 10 hold 68% in FY22. Since the upcoming capacities are also by the large players, hence the consolidated nature of the industry is likely to be maintained even after these expansions come on board. In our view, the consolidated nature of the industry would aid the industry's pricing discipline as well, even after the increased supply post-commissioning of the new capacities. Now moving on, let's see the cost side, the battle which just got intensified for the industry in FY23. The two main components in the cost structure are power and fuel and freight expenses. Together, they constitute close to 55 to 60% of the total cost. Over the years, cement players have been improving their capabilities to use both petcoke and thermal coal in their kilns and hedge the impact of the higher price fuel cost through the optimal fuel mix between the two. In the current year, both petcoke and thermal coal have surged up substantially and already over and above FY22 levels. Even on the raw material side, slight increase is expected due to the new mines share and higher fly ash and slag prices. All this may inch up the raw material price by 30 to 35 per ton. Our assessment universe covers the top 20 players in the industry, which put together is more than 80% of the industry. So the combined impact of all the input cost, which we were just talking about, is expected to inch the cost for all the players by 350 to 400 per ton. While there is a heightened focus on efficiency measures, we believe it would be difficult to fully offset the higher energy cost. And let us take a closer look at how these trends are looking like. The first chart gave us the trend of the coal prices over the years and how the per ton cost for producing the cement has moved in tandem with the same. The power and the fuel cost per ton increased by 31% year on year in FY22 due to significant increases in the coal and the petcoke prices. And this cost inflation continues in FY23. This cost is likely to increase by 300 to 330 per ton on a full year basis. And we have already seen it inching higher for the players in the Q2 results. Though we are currently seeing some signs of respite in the petcoke prices, the Australian coal largely remains at elevated levels. These prices continue to be soaring high, not just from the past averages, but also year on year. In the below graph, we have shown diesel price trends and freight cost per ton over the years. We are not expecting much increase in the freight cost as the volatility in the diesel prices has not been much on a year-to-year basis, though this is still high from the past averages. This cost may either remain flat or just increase by 1% from the FY22 levels. So the players need to take price hikes in a gradual manner such that it shall not weigh on the demand revival. In our estimate, an increase of approximately Rs 25 to 30 per bag would be required to offset the cost inflation. Let us look at the price trends now. Here in Exhibit 11, we have shown the average pan-India prices and average sale realization by players as presented in Exhibit 13. Since FY19, we can see an upward trajectory in prices at pan-India level, and even similar trends is observed region-wise also. In FY22, prices did increase by close to 5% on an already high base. And in the current year so far, till H1 of FY23, prices have not reported much growth over last year. In fact, in Q2 of FY23, because of the monsoons, there has been drop in prices. However, in the October end and November, players have started taking these hikes. Players need to take price hikes, particularly in order to mitigate the cost impact. In our view, the price rise will rise by 3.5 to 4% on a high base of FY22. And this, though, is not enough to completely offset the cost pressures, but these partial hikes in realization will limit some bit of expected margin contraction. Let us look at the margin profile of all the players. The current graph has the EBITDA margins at the top and the per ton EBITDA below. The cement realizations have remained quite firm in the last 2 years in the year of FY20 and 21, with players having taken timely price hikes leading to good profitability across the sector. Consequently, we can see in the current graph that the EBITDA margins in 20 and 21 have risen sequentially. Post that, the players started feeling the heat of rising input cost, particularly from the H2 of fiscal 2022. And we see that on a full year basis, players reported a drop in margin by approximately 430 bips in FY22. And this was despite volume and realization registering growth. The story repeats in the current fiscal as well. The players will not be able to fully offset the high input cost, though hikes in cement prices, given the unprecedented levels of the input prices. In our estimate, the moderation in the EBITDA margins on account of the above will be in the range of 320 to 380 bips. or an EBITDA per ton impact of 180 to 200 rupees. The point to be noted here is that this moderation is after assuming a price hike of 3.5 to 4% on a year-to-year basis in the current fiscal. If players are not able to take such price hikes on a sustainable basis, the drop in the EBITDA per ton can be steeper from the current levels which have been assumed. With the operating profitability moderating, about which we have spoken, and also with the upcoming expansion-related debt, both these factors together shall weigh on the return on the capital employed for all the players. And this is expected to moderate further from FY22 levels. This obviously is also sliding from the highs that the players witnessed in FY20 and 21 due to the robust profitability. Exhibit 15, which is the second graph below, is showing us the trend in the leverage and the interest coverage indicators over the years. Players have benefited from the current upcycle in the cement and have shed debt despite the pandemic. The net debt to EBITDA have been improving over the past years. And in tandem with that, with improved profitability and lower debt, the interest coverage indicators also improved and stood strong for the industry. In FY22, though operating profitability did moderated, but these credit metrics were largely in line with FY21. However, with continued moderation in the operating profitability and with the capex related debt, which is expected to now come up on the balance sheet of the players, the net debt to EBITDA and interest coverage will moderate from FY22 levels. But they continue to remain stable owing to the deleveraged balance sheets of the players earlier in 20 and 21 and the net cash positive position of the large players in the industry. The medium-sized players who are in expansion mode are likely to witness more contraction in the credit metrics. Coming to the rating dispersion of the care-rated players, being a consolidated industry with the long-standing and entrenched players, we can see that a significant 43% of the rated players are in the AA and above categories, 38% are in the A category, and only very small marginal players are in the lower rated brackets. Having talked about the industry dynamics and credit profile of the players, we summarize by saying all this that players will witness the moderation in their operating profitability for the second consecutive year, but the credit profile largely remains stable. The key monitorables are the ability of the players to take sustainable price hikes, also the ability of the players to manage or defer the ongoing capex vis-a-vis the moderation in their operating profitability, any variation in the demand drivers amid the upcoming capacities by the players is also monitorable. Further, any consolidation in the sector and industry to be able to maintain the pricing discipline shall also be monitorable. With this, we come to the end of our presentation. Thank you, everyone. I now hand over to Mradul to take the session forward. Over to you, Mradul.
Thank you, Ravleen. Now, may I invite Mr. Sachin Gupta to take over the proceedings, please? Sachin is a Chief Rating Officer and Executive Director at CareEdge Ratings and has over 22 years of experience in leadership positions across the credit rating business. Prior to joining CareEdge, he worked as a Senior Director at CRISIL and managed the corporate and infra ratings. Over to you, sir.
Thanks, Madhu, and thanks, Ravleen, for the presentation. So, let me introduce the panel that we have. In fact, we have quite a strong panel today, and especially in the current times. And in the Ravleen's presentation, we saw that there are some challenges or some issues which kind of industry faces, which all the analyst community would want to, hear the veterans of the industry to speak about. So, very happy to announce our panel. So, we have with us Mr. Arvind Pathak. He's the Managing Director and CEO of Birla Corporation Ltd. Mr. Pathak is the MD and CEO of Birla Corporation, and he has over 38 years of overall experience, including 36 years in the cement industry. Earlier, he's worked in ACC, Dangote Cement PLC, Adani, and Reliance ADAG. He's an industry expert and has a strong track record of planning and executing long-term business plans. He holds an electrical engineering degree from IIT BHU and PG degree in industrial engineering and management. A very warm welcome, Mr. Pathak. Then we have with us Mr. Dharmender Tuteja from Dalmia. Sorry, I think, okay. My apologies, I think the slides was a bit delay in that. So now we have with us Mr. Dharmender Tuteja. He's the CFO for Dalmia Bharat and Dalmia Cement Bharat Limited. His total work experience is of about 34 years in finance, commercial and business management role, and he has been working with the Dalmia Group for the last 10 years or so, and he has held leadership position in finance and commercial functions. And before Dalmia, he's worked with KHT, Humboldt, Vedag, Samtel Group, Controls and Switchgear Group, Cribco, and Sale. He's a member of the Institute of Cost and Management Accountants and Institute of Company Secretary, and he's an alumnus of Shriram College of Commerce. A very warm welcome, Mr. Tuteja.
Thank you.
Then we have with us Mr. Jigar Shah from Wonder Cement. He's a CFO there, and he has over 18 years of experience in the field of finance and strategy. And before that, he's worked for Vedanta and Kalpataru Group. He's a chartered accountant with a BCom degree from HL College of Commerce at Ahmedabad. A very warm welcome, Mr. Shah.
Thank you so much.
And finally, we have with us Mr. Anil Sharma. He's the CFO of HeidelbergCement India Ltd, which is a subsidiary of HeidelbergCement AG, Germany, one of the world's largest integrated manufacturers of building materials. And he successfully headed the merger of Indorama Cement Limited with HeidelbergCement in 2008 and various M&A transactions during the last 10 years. Mr. Sharma holds a BCom degree from University of Rajasthan and is a qualified chartered accountant and a company secretary. And he has also been recognized by the Institute of Chartered Accountants of India as the best CFO in manufacturing sector in India in Jan 2019. A very warm welcome, Mr. Sharma.
Thank you, Sachin.
Great. So, let's start the panel discussion. And, the first question I thought we can maybe start with the demand side. And my question is to Mr. Pathak, being I would say the senior most veteran on this panel today. Sir, we typically the analysts look at the demand year-on-year growth kind of a number, right? Now, because of the last 2 years, because of pandemic, because of lockdown, in some ways it has become a little difficult to really see what kind of demand is there. And even when we see the demand uptake, I mean, the one question is it a pent-up demand which is coming through, or is it a sustainable demand that you're seeing? Now, our analyst, as we saw in the presentation, is projecting a growth of about 8 to 9% in the current year and a more long-term growth of 7 to 8%. Now, being the industry veteran, how do you see this panning out? In your vision, do you think these numbers are kind of tenable, and what could be the potential risks there, from a demand perspective, sir?
Okay, thank you, Mr. Gupta. Your present is very aptly covered where we see the market demand to move. And I think most of my co-panelists will agree with the numbers presented by your team. Now, if I look at it historically, even if I look at the pandemic days, except for the period when there was a complete lockdown or shutdown, industry did see a reasonable demand in the market. And one healthy side of it, which is coming out of your presentation, and there would be some aberration that I would like to that. Slowly, the reliance of the cement market only on the housing is decreasing. Okay. It could be a positive sign, it could be a negative sign either way, because it will change the dynamics of how do you sell the cement, whom to sell, whether we sell it in bulk, whether the quality, average quality, or the variation in quality, the branding, the product really, and say, what is that which will make a difference to customer? And once we have this mixed change, when you shift from a housing to an more of it engineering-based infrastructure and industrial sector, the emphasis has to be reinvented. And it also gives us an opportunity that moving from housing more than just going by the brand which the companies have created, there would be other things as far as service levels are concerned, the quality which will become important. So the very fact that since we have a dispersion of the distribution of demand, and even in that demand, which you look at housing, there is a great amount of element which is coming from a government-sponsored demand, whether it is a PMIG rural, whether it's for urban. The only thing that I would like to see is that seeing that the industrial number goes up. Industrial number going up, not primarily from the cement demand, but that would have indicated that in the country, the private investments are coming. That will be an indication of that. And which will make this demand more sustainable. Today, whether we like it or not, whether it is, we call it housing, which I said is a government sponsored, whether do I call it the commercial or infrastructure, they're all coming from government. And there could be a stage when government may find it unsustainable if, let's say, something as serious as COVID comes up again or some other form, something happens. So having to see a growth in industry, I would make it that will make the each buckets more powerful. Having said that, and if we look at the population that we have and the growing size of the middle class, the demographic of the country, I am very confident that the numbers that we have presented would be the number that I would be comfortable to live with, and would also be comfortable on a pessimistic side to make my plans on that. When I'm making a conscious statement, pessimistic, but I expect a slightly higher number. And there would be obviously a regional disparity. So I feel that industry wouldn't have a opportunity to complain on the growth or the basic quantum of the cement demand in the country.
Got it, sir. Very well said, and I agree with you. As a rating agency, we have to be a bit more conservative. As a business leader, you have to be, more optimistic. Let me bring in Mr. Tuteja here. And Mr. Pathak also hinted on this, diversity across regions. How do you see, because in the presentation, one interesting thing I noticed is that somewhere the view is that, the north, central, and the eastern will kind of lead to a higher growth in future, and the west and south will be a little bit muted. Broadly, do you agree with this? Because generally west and south have been, the relatively more advanced, development focused kind of states historically. So in that sense, do you think that broad understanding is correct? And also, are there any pockets that you feel across these 5 regions where there could be, more pressure on demand versus the others?
So in the last couple of months, definitely the west, especially the Maharashtra region, or in the south, maybe a couple of pockets like Telangana or Andhra, maybe have underperformed in terms of demand growth. But that could be also partly because of the availability of funds with the state governments to boost their spending schemes and to boost the income levels in the concerned states, etc. But overall, I don't think this is going to be a long-lasting phenomenon. In the past, as you said, that West has been a very strong market, South has been a very strong market. So they'll definitely bounce back. And with the overall, let's say, the thrust of the central government for the economic growth of the country, RBI also, of course, trying to cool down the inflation, but still supporting the government in terms of the growth objectives. And the income levels rising and India being a shining star, I don't foresee any issues. Overall, these sectors also catching up soon.
Got it. And you very rightly mentioned, I think the government has been, one of the key things that the government, while Indian government has not spent, as much money as, say, foreign countries during the pandemic, but this year the budget clearly is focusing on the capex, and that is really
very supportive,
directly or indirectly will kind of help in the demand generation for cement sectors. Let me get Mr. Shah into the conversation. How do you think the north market playing out? Because cement industry, as all of us know, is very, very sector or rather the region focused. So in the north, how do you see that? Especially there is a fair bit of, while there is a demand, there is also a lot of capacity additions which are happening. So in that context, how do you see the demand playing out, and what's the sustainability of the demand growth there?
Yeah, sure. So Sachin, I'll just add one perspective to what Mr. Pathak has also mentioned, and in this demand part, particularly north. So north is very rich area, particularly in the based on the crop and everything. And when we'll see the overall, and presentation also Ravlin has mentioned that overall demand side, the consumption side, cement is almost 2/3 is from the housing sector. Okay. And in rural, what we witnessed over years that that everything depends on the how successful is the monsoon and the ultimate the crop cultivation. So it's a rich area, particularly where the demand is coming through the rural sector also. And when we'll see about the rural sector, that everything is about the quality that person is spending their hard-earned money and everything. Apart from that, North is also witnessed the strong demand growth in terms of the industrial, not industrial, it's about the governmental spend also. And majority of projects that including the high-speed rail network, which will come up in the from Delhi to say Ahmedabad and Ahmedabad to Mumbai also, plus the few road projects that is witnessing the clear growth. It's not only about the particular infra projects, but the surrounding which is getting developed according to the infrastructure development and the big projects. So that's why that North is a little bit on the upside compared to the other regions in terms of the forecasted demand also. And the different states which likely Punjab, Haryana, Uttar Pradesh, as well as Northern Rajasthan, everything that is, and particularly the NCR, that is also it's almost a 40% driver is NCR itself. So that's why demand side, the North region will say definitely have the upside compared to the other regions in that, if I'll consider that scenario. You are on mute, Sachin. Sorry.
Thanks. Sorry. Okay. Now, Mr. Sharma, from one big thing that we noticed in the presentation also, that 2/3 of the demand is pretty much coming from the residential housing, kind of not residential, but housing overall. Now, where do you see, again, that is where my the earlier question also that I had put, that are we really seeing a pent-up demand kind of coming through? And therefore, because, the residential housing was pretty much going through a lull phase till about 2019-20, almost a 5-year lull was there. And now we are seeing that suddenly there is a lot of projects being announced and all that. So, from where you sit and the kind of sense you are getting, how do you see the residential demand kind of playing out in the short to medium term?
Thank you, Sachin. I think what the Ravlin has mentioned in the presentation, and I do agree most of the data with respect to residential demand, and especially the housing sector, which we say that okay, it is more than 60% contributing to demand side. And during last maybe the pre-COVID last 5 years, the residential sector was not so moving in the right direction, or demand was not so good. There were many reasons. Maybe one of the reasons, maybe the excessive the inventory, and at the same time the people who are working in the metro cities, maybe the development happening in the tier 1 or tier 2 cities. So we have seen that we have not have the much growth on the residential sector, especially in the metro cities. But thereafter, post-COVID, in this real estate sector, there was a lot of demand came out, and because of that, the inventory has been exhausted, and therefore we have seen many launches and many new projects came during the last 1 year. It has resulted into slightly increase in the growth, but the main growth has come during the last maybe 5 or 6 years, even post-COVID, is from the rural side. So rural economy has many driving force or driving growth in the cement sectors, and that's why it is coming mainly from the rural side. But now, last 1 year, we have seen that there is also change, and the rural economy also not so has grown in that direction, and it is little bit muted and moderate. So last 1 year, maybe we have seen that okay, rural economy has grown by 6%, and on the residential side also the growth is around 6 to 7%. Main growth is coming from the infrastructure side, and infrastructure we know that okay, there is the thrust from the government side. As well as the government is putting many projects, we call it maybe the expressway or the metros, or maybe a house for everyone. And being the pre-election year of 2023, we all know that okay, always we see some kind of infrastructure push from the government side, or maybe to complete the many projects. So I personally feel that demand growth in the coming maybe 12 to 18 months should be good. Mainly from the infrastructure, followed by the residential sector, and thereafter we can say third maybe on the housing side.
Got it. Thank you, Mr. Sharma. So broadly we are kind of all the panelists, and the care view is also kind of reasonably benign to positive on the demand side. The problem, however, is, as all of us know, has been more on the cost side, and which is where I would like to ask my next question to Mr. Pathak. That how do you see that we saw some of the results which have come out for Q2 showing pretty sharp reduction in the profitability, and it's almost across the board. Now, are you seeing some respite? We know there was a commodity kind of a surge across the commodity spectrum, not only for cement raw material, but even otherwise. So there are some commodities which have come down quite sharply. Now, how does your what should I say, the basket of raw materials, how is that playing out? We saw that power and fuel is really the one where the sharpest increase was there. So how do you see it having come down already, and what's the outlook for the future, maybe for the next 3 to 6 months?
Okay. Thank you, Mr. Sachin. I think basis of our discussion on Q2 alone numbers, I wouldn't say it will be unfair, but we'll be slightly looking very pessimistic. Because if you go back into the timeline of 12 months, that was the time when really the pain point started for the industry. So your base comparisons are not the same. So what was there in Q2 of last year, what is the Q2 of this year? And Q2 also happens to be a monsoon month, monsoon period. And so any impact will have a greater leverage wherein the differences become very sharp and strikingly different. Q3 normally is a recovery quarter and Q4 is the one wherein things look good for the industry. So we shouldn't get biased by that. But now coming back to your point about the commodity prices, yes, we did see a price increase last year, and that price increase have continued this year as well. Though if you put it on a graph, you will find the rate of increase of prices on the commodities have slowed down. Now, maybe before we came into the discussion, there was some off-the-record discussion. We were having exchange of views. Some of these, whether it's pandemic, whether it is high cost, low profitability, some way it is, I wouldn't say it's a good thing to happen, but it is a necessary evil to put all our brains of the industry together, go back to the drawing board, relook at our processes, relook at it, how we can. Otherwise, this industry has been there for so many years. Some really shake-up does lead us to some great innovations. Now, if I have to look into what you were talking about, power and fuel, most of the companies, I think most of the people who are there in the discussion will also agree that to a very large extent, the impact on power has been mitigated. Whether it has been solar, whether it's a waste heat recovery, people have moderated the CPP working grid, etc., etc. So truly, there is one big challenge that the industry faces, basically fuel. If I have to single out one particular item. So yes, the price will go up. And I wish I had a very clear-cut answer for this, because there are certainties like Ukraine war, etc. And some of these things like COVID and Ukraine war has also shown that earlier we used to think that cement industry in India is a specific industry. And some of these things have exposed us that we are no more a localized industry. We do also get largely influenced by what happens in the globally. We see some positive signs of Baltic index coming down. We do see some signs of petcoke coming down. So there would be some hopeful of signs, but not a very significant one we should expect. And I'm sure all what my colleagues I have been talking to, lot of efforts are being put also to economize on the fuel cost, where some of things have been listed in your presentation, like popularizing more and more blended cement, going into alternative fuel, which besides cost will have other thing. So the impact would get diminished with the volume growth taking place in Q3, Q4, tapering of the prices to a large extent, some favorable tailwinds coming in form of Baltic index, etc., which will bring down the thing, and innovations that are being carried out, wherein people will learn to work with less of clinker, produce clinker at a cheaper cost, etc., etc.
Got it.
So yes,
yeah,
but not as severe an impact as what we faced in Q2. So let's not see more than what it is.
Got it. Mr. Tuteja, how do you see this? So while Mr. Pathak has given good perspective in terms of how some things of some softening is happening, but there are also issues in terms of high cost inventory may still be there, because you don't really know which way the petcoke prices are going to move next quarter. So I'm sure from a security perspective, the companies would have stocked up. So do you see Q3 in some ways being kind of benign in terms of the cost impact vis-a-vis the Q2 of this year? Or do you think that it will kind of have any major impact?
Yeah, definitely the worst is behind us. The Q2 was the worst quarter in terms of the commodity margins, etc. Q3, as already rightly said by Mr. Pathak, people have already taken multiple initiatives. Besides this power initiatives, etc., the blending ratios have improved, which you already covered in your presentation also. And the increasing use of the alternate fuels, or the green fuel, which we call it, all this have already helped to reduce the costs. And good thing is also that in the second half, the volume also goes up. Typically, the first half is 45% and second half is 55%. So increasing volumes, cost reduction pressures, as well as the price hikes have also started, I think, getting affected from October onwards, which is also a positive sign. And as the demand traction improves in the second half, we'll be able to pass on a couple of these price hikes. So we expect that the margins will definitely be better in the coming quarter.
Got it. And that will, let me get Mr. Shah also to his views. In terms of the price hikes, Mr. Tuteja is talking about price hikes. And that is really I would say, the strength of the industry, wherein whenever there were the cost hikes, generally, with some lag, it was matched by the price hikes. This time, for last 12 months or so, as we discussed before, it has not been as prompt, I would say, for various reasons. I'm sure demand was an issue and otherwise. So how, the more specific question to you is, how much price rise do you really see? Obviously, it will vary, player to player, region to region and all that. But if we were to take a ballpark sense, what kind of a price hikes do you think the industry will need to take? Ravleen also mentioned about some base case that she's taken. But what is your sense at a overall level?
Sure, Sachin. So if we'll see for the industry now, overall, that 2021 financial year, that was perhaps the base year when the industry is largely in the bracket of, say, 25% EBITDA margin. Okay. And at that time, the prices, the petcoke prices, which is primary fuel, which is almost 1/3 in today's total cost component, that was hovering around $80 to $90. Which went up to, say, $270 to $275, and today it's moving around $180 to $190. Okay. So what we have witnessed as an industry, that the base price, which is a primary fuel of any particular industry, which was at, say, X amount in 2021, when the industry was operating at 25% margin, that went up by around 60% in 21-22, and that another 50-60% in the year 22-23 till date. So collectively, if we'll see, that is impacting almost 45 to 50 rupees per bag of PPC bags. Okay. And in terms of OPC, that definitely is around 75 to 80 rupees per bag of cement. That is only one of the component, which is only 1/3 of my cost. Okay. There are other components, but however, thanks to that, all the logistics mix, innovations, efficiency, reducing the lead and everything, though the diesel prices increased from 70 to 100, but industry is not witnessing the increase in terms of the logistic cost or freight per ton of my final output. However, the other cost component, which is remaining 1/3 component, if I leave out the 25% as EBITDA margin, that other component is also has an inflationary pressure in terms of all the overheads and everything. So putting together is that the requirement of increase, even if I'll particularly to your question, that to go back to the 25% kind of EBITDA margin, industry required minimum 40 to 50 rupees a gross price hike. Okay, so that means in terms of if I'll go for the 50 rupees increase from today's level, that will bring the industry to 25% of EBITDA margin. Go back to the 2021 level. So that is the increase. And though it's you mentioned that considering the overall industry level, the utilization is somewhere around 70%. It is not really, I can say, an easy task, but to sustain the industry, this is a must requirement for any industry to go back to at least a healthy profit margin, because we have witnessed the results for at least H1 and last year also that industry is suffering because of the cost pressure. And this is now the new normal. So we have to look for the upward price increase.
Got it. No, very, very well explained, Mr. Shah. So, I mean, the next question which obviously comes to mind is, and I'm sure that is the thought in all our audience, fine, there is a gap of, say, 40-50 rupees that you say. What is the time period that you think over which this can be taken? Assuming the cost remain, obviously that cost, if that comes down, petcoke comes back to $100, maybe then the gap also will kind of reduce. But assuming it is there, do you see that industry will be able to take these in the next, how much time you think that's possible?
See, looks like from any, particularly if I see only the industry side, then definitely it's at the earliest is a possibility. But we have witnessed as a overall, as economy wise also, that we have witnessed that from October onwards, there is an upward movement already started in terms of pricing. So it's a gradual process. It's not like that one day that prices remains, it's a increase by 50 rupees. It's a gradual process, but definitely industry will, the prices to support the industry, the input cost, the prices will go up in, say, if I time zone wise, then definitely in 1 to 3 months, we'll see the definite increase in the terms of the prices. Unless there is a softening of the coal cost further, from today's level, say 180 plus, if the indices will go below to that 150 level or max, so then there's definitely the price increase will be different. But at current level, definitely there will 40 to 50 rupees increase will be visible in near future.
Got it. Thanks, Mr. Shah. Mr. Sharma, so this is the thing, that there is a gap, and if the price hikes can be taken, but our typical microeconomics teaches us that if you increase the prices, then it could have a adverse impact on the demand also. So, again, it depends on essential commodities. Maybe it is not so, and cement maybe at some level is an essential commodity for infrastructure development, for residential, etc. So how do you see that, in terms of if there is a price hike which kind of the players were to take? Do you think that there will be an impact on the demand, and that could, which is what we understood in the past when there were some price hikes, and then the demand kind of slowed down, and then the price hikes were reversed. So how do you see that playing out in the current situation now that the monsoon is behind us and the demand seems reasonably robust going forward?
Sachin, I think we all agree that the major problem for the cement industry was not on the demand side or the price. It was the less problem. Problem was the more on the cost side, because cost during last 1 year is increased more than 20%. And the cement price has a limited elasticity that we can't increase in one go, or no one will be ready to pay the 50 rupees higher the price per bag on the next day. So it has the limited possibility always to increase the price in one go. But there is the requirement, and everyone knows that if you don't increase the price, then it will be the question of the sustainability and survivability. Now, on the cost side, again, I also raise one more point that the government or railway has also now started the peak season surcharges, so that also increase the logistic cost. But the silver line I can see about the availability of the coal from the Coal India, because the last year, maybe last 2-3 quarters, we faced the problem not only the international coal prices, but because of the non-availability of the local coals, and because of that reason, our fuel cost has increased. And now, considering all the building material cost and the commodity prices, this fact will remain same. Maybe degree of the cost may slightly softening. It may reduce, but it is not going to reduce to 20% by the cost. So we don't have any option rather to increase the price. I believe that now all the festivals has already been over, which is maybe during that time we could not increase the price. And November, when we see during last 2 weeks, we have seen that the offtake has, especially from the secondary market, the offtake has started increasing, which is the good thing that the demand is there. And as we move along, maybe next 2 to 3 weeks, I think we will start seeing the more demand in the market, and it will support to increase the price. And I believe that price may not have the much impact on the demand side. Means if we today increase the price by 10, 20, 30 rupees, and if somebody thinks that the demand will reduce, I don't think so. Demand is there. It is coming from the requirement of the consumer or from the infrastructure, or especially government side. So that will remain there. And the industry, not only industry, but consumer also believe that when you see all other commodities, those prices has become double and triple, and cement remain there at the same range of the 360, 370 bag. So everybody knows that, okay, this is not the realistic or reasonable cement price. So the appetite and the acceptability in the market is already there. So it is only thing is that we see the demand offtake and we increase the price. Like Jigar says that, okay, 50 rupees, that is must. Maybe it may come in 2 to 3 months, but that is going on, and I think that will sustain also in the market.
Got it. No, very helpful. I'll take one more question, and then I think we will open. But then the point is that there is still a moderation in profitability, and still we see that the players, most of them, are in a capex mode in terms of expanding the capacity. So do you think with this now last 12 months or so, being a little bit, dampener in terms of the cash accruals for the industry, do you think there will be kind of a slowdown in the capacity additions? Also, there is a new player who's kind of, from an M&A perspective, who's come. Keeping that in mind, do you think that will really change the industry aggression, I would say, in terms of adding capacities?
I do not think so. Reason being, all these capex additions, they are strategic and long-term in nature. So long-term outlook for the sector has not been changed. Rather, cement industry, like any infra industry, rides on the India growth story. So that remains bullish. In the long run, we do expect that the demand will definitely grow by 8 to 9%, and all this capacity. So they are in tandem with the growth in the demand. And most of these capex announcements are by the large players who already have very healthy balance sheets. So they don't have any stress in terms of margins, etc. So even if margins compression is there for a couple of quarters, that can be easily withstood. So I do not think that that there will be slowdown in the capex appetite of the large players.
Got it. Great. Thank you. So, Mridul, can we now open the floor for questions?
Sure. So dear participants, we can take your queries, please. You are requested to key in your panel if you have any queries to pose for the panelist.
Okay, I'm getting some questions here. So let me just take the first one. Okay, this question is from Anand Kuriakos. The question is that capacity utilization in the industry is around 65% and current capacity is enough for meeting incremental demand for next 5 years. Then why companies are aggressive on capacity addition? It is a time to divert the capacity addition in another sector for the larger benefit of the country. So Mr. Tuteja had just shared his view, but maybe I can get Mr. Pathak to respond to this. Mr. Pathak, did you get the question?
Yeah, I got the
Basically
question.
saying if you are at 65%, why bother spending more money? Let it maybe reach 75, 80 and then invest the capital.
Okay. Firstly, let me answer the 65, 66 question. Not that I am challenging the data, because we assume when calculating the percentage as if the production and the supply would be averagely constant throughout the year. There would be quarters, there would be months wherein production will have challenges, sometimes market. So if I were to realistically sort of calibrate the data, my number would be anywhere above 70 plus, 70-75%. Having said that, I think my esteemed colleague who has asked this question, I'm sure he would be in industry or industry-related area. Any project, if I look from conceptualization, it takes almost around 4 to 5 years. Because today to get the mining leases, to get the land, etc. And in 4 to 5 years, if you look at it, 7 to 8% increase, we are talking of 28 to 30% growth. So most of these works which start take place on anticipation. And those anticipations, as Mr. Tuteja rightly said, the story of the industry in India is still intact. And with 7 to 8% growth, and anything which comes close to 80, 85 is a tipping point for us for an investment. And some of these people could see good times. We have got a healthy balance sheet, so they could afford to make that investment. So I think we shouldn't be looking at a very short term or a quarter to quarter basis. Some of these decisions are more strategic, more long term, and could be area specific.
So, okay, thanks for that answer. Let me just get Mr. Tuteja in this. I have a follow-on question of myself. I agree with you that if 7 to 8% growth is happening and 65 maybe is in reality is maybe not 65, maybe 75 and all that. But the key question is, if the price rise were not to happen, then I think all the bets are off the table in some way. So, I'm sure the industry is watching, looking at each other or taking their own decisions. But the accruals will certainly be impacted if the the price hikes don't happen. So in some ways, will it be dependent on that once the price hikes happen, and then maybe people do, and maybe once they stabilize, and then the corporations will have confidence to go aggressively or actively on the capex. Mr. Tuteja.
So that for any industry, these kind of cycles will always be there. There will be upside and downside. So that prices of inputs remaining at all-time high for all time to come, again, is an unrealistic scenario. So something has to fall in line. Either prices will come down on the input side, or naturally these cost pressures will get passed on in a measured fashion. So the normal profitability has to come into operation. There will be some players who will definitely be stressed because they'll not be able to command that kind of premium pricing or the cost advantages. Some players will command better than the average margins. So this kind of pulls and pressures will come. There will be consolidation happening in the industry. Weaker players will give way to the larger players. The large 5-7 players will definitely have a much greater share of the market. This consolidation will definitely improve pricing discipline. So overall, I don't see that situation that why should we get worried about the last 2-3 quarters stress.
Got it. The next question that we have is, that how do you see the future M&A in the cement sector? Maybe Mr. Sharma, you've managed a M&A in the past transaction. Maybe I'll come to you for this. The future M&A transactions in the company, in the sector.
So Sachin, cement, as we know, really a fragmented industry in our country. Unlike Western countries, when we compare with Europe and the US, there you see more consolidation. Where in India, still more than 50 cement companies have been operating. We have seen during last maybe 1 decade more, the lot of consolidation happened, but that is not the end of journey. I think there is a lot of opportunity and a lot of scope is there, and we will see rather more aggressive merger and acquisition during next 10 years. The reason is that the cement is the capital intensive, and this capital intensive requirement has been increasing day by day. We have seen during last 5 years about the compliance capex requirement, as well as in order to optimize your cost, you need to bring more and more capex, and that is not possible if you are stand out or maybe a single out in the entire operation. And second thing, which is also developing during last 10 years, that is the difference, whatever the difference between one region to another region, those are basically now becoming more stabilized, more uniform, and more maybe the movement of the material from one region to another region. So if somebody is in one region and he thinks that, okay, it is not impacted by the competitors, that's not going to happen. So all these factors, I think, bringing more consolidation, more merger acquisition. So I believe that yes, cement, it may not happen overnight. Cement will remain fragmented maybe more next 10 years, but ultimately it is moving towards direction of the consolidation.
Got it. Next question, a little different take. We've not covered it in the discussion today. This is on the ESG, and maybe Mr. Shah, you can take this. Is there a possibility of any regulatory stipulations that can lead to a financial impact on the sector?
See, as of now, Sachin, in terms of ESG, we have seen that even in if there is not a strict regulation or any regulatory requirement, but players have already started and matured industry. It is that the ESG part, we are moving towards the increase in the AFR consumption, alternate fuel. Okay. That is one is obviously that it's on the environment side also, that impact is that benefit. And second is about the optimizing the coal cost, increased fuel cost also. So that is increased AFR consumption. Then industry as majority of players has already started about the usage of the ammonia to moderate the impact of the NOx also. Okay. So that is also majority of players already started. So apart from everything, it's regulatory or not, but industry is matured. Green power, that again to moderate the cost impact in terms of the power prices, that people have started and moving to the other green sources of green energy also, be it WHRS or solar or wind. So that industry is mature enough and started. I don't think anything is major in regulatory terms which will come up, which may have impact, because otherwise these are all are in course and regularly companies are taking care. I don't foresee any major change which will have an impact on the capex side or any operation side for the industry.
Got it. maybe this is the last question we can take. We have just overshot our time by 5 minutes, and let me get Mr. Pathak on this. And this is essentially, people. The question is that if the players go ahead with the capex plans amid the subdued profitability, they may need to relook at their funding mix. And essentially, the way I'm reading it is that till now there is not generally an equity raise that the companies have been making. Because the internal accruals plus a little bit of debt is what has been able to fund their capex plan. If you look at the last 5-7 years, do you see equity raises by the players in the near future?
See, Mr. Gupta, necessity is the mother of all the inventions, right? So today this industry has been fortunate enough wherein most of the entrepreneur-driven organizations, they had access and they were business model was allowing to what you have internal accruals and with something taking loans, etc., and taking your business forward. With the magnitude and the complexities and the big players coming in, and some of them I see have a different mindset. I wouldn't be surprised if this sort of activities also take a shape in the days to come, and which many of my CFO friends will be busy in doing all those sorts of things. So I definitely see that happening in the cement industry as well in coming days.
Great, sir. Thanks a lot for your views. And so if I were to broadly summarize, before we kind of close this thing, the key thing I think which all of us are agreeing is that the demand will be kind of growing at whatever 7 to 8 to 9 kind of a percent in the next 2 to 3 years, which broadly we are all agreeing. One opportunity that panelists said that when on the high cost side there was an opportunity for various players to look at their cost structure and maybe they will get some cost efficiencies from there. The third point which came out very clearly was the price hikes. We mentioned that maybe the price hike of about 40 to 50 rupees has to be achieved in order to get the profitability back to the years of 2021 or so. And also a clear thing which came out was the capex for capacity addition will continue, and the strong players, the larger players, maybe they will have a larger share whose balance sheets are stronger and who will be able to borrow at economic price. And then yes, Mr. Pathak did mention towards the end that yes, in case the need is there, then yes, the equity raises could also happen in order to fund the growth of the cement industry. So great, thanks a lot, all of you. It was really a pleasure for me to moderate this panel, and thanks for your time. Mridul, can you please take it forward from here?
Sure, sir.
Thank you.
Thank you, Sachin sir and Ravleen for the presentation, and to our guest speakers for the insightful views, Mr. Pathak, Mr. Tuteja, Mr. Shah, and Mr. Sharma. It was a privilege to host you. And thank you to all participants for taking your time out and being a part of this session. For any further queries, feedback, or suggestion, you are most welcome to write us in the feedback mail, which will be coming when no sooner the webinar ends. I request the tech team to log off, please. Thank you.
Thank you, sir.
Thank you, sir.
Thanks a lot.